If you're an executive receiving stock compensation, you're sitting on an incredible wealth building opportunity. But here's what most people don't realize. Stock compensation comes with complex tax traps that cost executives tens of thousands of dollars every single year. The good news? These 5 tax moves can dramatically reduce your tax bill and accelerate your path to retirement. As a financial advisor with over 10 years of experience working with executives and professionals earning over $200,000, I've seen firsthand how the right strategies can save you serious money. In today's video, I'm walking you through exactly what you need to know to keep more of your hard-earned compensation in your pocket and out of Uncle Sam's hands. Let's dive in. Let's start with the biggest mistake I see executives make with restricted stock units: underestimating the tax withholding. When your RSUs vest, they're taxed as ordinary income at the fair market value of the shares on the vesting date. That income gets added to your W-2, just like your salary. Now, here's where it gets tricky. Most employers withhold taxes at a flat supplemental income rate of only 22% for federal income tax on RSU income under $1 million, and 37% for amounts above that threshold. But if you're a high earner, and chances are, if you're receiving significant stock compensation, you're likely in a higher tax bracket. For 2025, the tax brackets for high earners include 32% for income between $191,951 and $243,725 for single filers. 35% is from $243,000 up to $609,000, and 37% for all income over $609,000. Let's say you're in the 35% bracket. Your employer withholds 22%, but you actually owe 35% plus state taxes and maybe even the 3.8% net investment income tax. That gap can create a massive tax bill at year end. If you're not prepared, you could also face IRS underpayment penalties. The IRS requires you to pay either 90% of the tax shown on your current year return or 100% of your prior year tax liability to avoid penalties. If your prior year adjusted gross income was over $150,000, that safe harbor threshold increases to 110%. So what's the fix? First, calculate your true tax liability. Work with your CPA or use tax planning software to estimate your year-end tax, including your RSU income. Then adjust your W-4 to increase your withholding through your HR department, or make quarterly estimated tax payments using IRS Form 1040-ES. This proactive approach helps you avoid surprises and penalties. Now, you might be wondering, why do so many executives get this wrong? There are a few common reasons. First, many people assume their employer is withholding enough. They think, my company handles payroll taxes, so I'm covered. But the 22% default rate is statutory. It's not customized to your personal tax situation. Second, executives often don't realize how much additional income their RSU vesting is creating. Let's imagine a hypothetical situation. You're earning a $250,000 salary and $150,000 worth of RSUs vest in a single year. That's $400,000 of total income, pushing you well into the 35% or even 37% bracket. But if your company only withheld 22% on that $150,000 of RSU income, you're short by at least $19,500 in federal taxes alone. And that's before state taxes. Third, people frequently overlook state income tax obligations. If you live in a high tax state like California or New York, the state tax hit on your RSU income can be substantial. The consequences of getting this wrong are frustrating and expensive. A large unexpected tax bill in April, potential underpayment penalties, and cash flow stress if you've already spent or invested the after-tax proceeds from your vested share. The solution is simple, but requires proactive planning. Review your total compensation picture early in the year. Estimate your tax liability, including RSUs, and adjust withholding or make estimated payments quarterly. The second tax move every executive with stock compensation needs is tax loss harvesting in your taxable investment accounts. Here's how it works. Tax loss harvesting involves selling investments that have declined in value to realize capital losses. Those losses can then offset capital gains from other investment. And here's the key benefit. If your capital losses exceed your capital gains for the year, you can use up to $3,000 of those excess losses to offset ordinary income annually, such as income from vested RSUs. Let's walk through a hypothetical example to see the math. Imagine you sell investment A at $30,000 loss, but realize $25,000 in gains from investment B. Your loss would completely offset the $25,000 gain, so you'd owe no capital gains taxes. You then have $5,000 in losses remaining. Under current tax rules, you can apply $3,000 of that remaining loss against your income, like income from your RSUs. And the leftover $2,000 can be carried forward to offset gains or income in future tax years. For someone with a 35% marginal tax rate, that $3,000 deduction saves $1,050 in taxes. Add in the savings from offsetting the $25,000 capital gain, and you're looking at a substantial tax savings, potentially over $8,000, depending on your capital gains rate. But there's a critical rule you must follow, the wash-sell rule. The IRS prohibits claiming a tax loss on a security if you repurchase the same or a substantially identical security within 30 days before or after the sale. Violating this rule disallows the loss, eliminating your tax benefit entirely. The best practice: sell the losing position and immediately reinvest in a similar but not substantially identical investment. For example, swap a S&P 500 index for a total market index fund. This keeps you invested in the market while capturing the tax loss. Here's what most people miss. Tax loss harvesting isn't just a standalone strategy. It's most powerful when coordinated with your overall equity compensation plan. Many executives receiving stock compensation end up with concentrated positions in their company stock. This creates two challenges: concentration risk and potential tax inefficiency when you eventually diversify. This is where the coordination comes in. If you're planning to sell some of your vested company stock to diversify, which would create a taxable gain, you can simultaneously harvest losses in your investment portfolio to offset those gains. This allows you to rebalance and diversify without triggering a large tax bill. Additionally, consider the timing of your loss harvesting relative to your RSU vesting schedule. If you know you'll have a large RSU vest in Q4 that will push you into a higher tax bracket, look at loss harvesting to maximize your $3,000 ordinary income offset. And remember, any losses you can't use this year, they don't disappear. They carry forward indefinitely, providing ongoing tax benefits in future years. This makes tax loss harvesting especially valuable during volatile market periods, when you can capture substantial losses to use over multiple tax years. The third tax move is maximizing deferred compensation opportunities, if your company offers them, during your peak equity compensation years. Non-qualified deferred compensation plans, or NQDC plans, allow you to defer a portion of your income to a future date, typically retirement. Unlike 401ks, which have a contribution limit of $23,500 for 2025, or $31,000 if you're over age 50, NQDC plans have no statutory contribution limits. Here's the powerful tax advantage. You defer income from high earning years when you're potentially in the 37% tax bracket to retirement years when you might be in the 24% tax bracket. Let's look at the math on a hypothetical scenario. If you defer $100,000 from a year when you're in the 37% bracket to retirement when you're in the 24% bracket, you save $13,000 in taxes on that $100,000. Now, I want to be direct with you. Deferred compensation plans come with risks. The funds remain on your employer's balance sheet, meaning they're not protected if the company faces financial difficulties. You're essentially an unsecured creditor of your company. Additionally, non-qualified plans must comply with strict IRS rules under Section 409A, including specific timing requirements for deferral elections and distributions. But for executives at financially stable companies who are confident in their employer's long-term viability, the tax deferral benefits can be substantial, especially in years when you receive large equity compensation that pushes you into the highest tax brackets. As always, the key is to run the numbers with your financial advisor and understand both the tax benefits and the risk before committing to a deferral strategy. The fourth tax move is using charitable giving strategies with your appreciated company stock. If you're charitably inclined, donating appreciated stock instead of cash provides a double tax benefit. When you donate long-term appreciated stock, shares you've held for more than 1 year, directly to a qualified charity, you receive an itemized deduction equal to the stock's fair market value. and you avoid the capital gains tax you would owe if you sold the stock first and donated cash. Here's a hypothetical example to illustrate the savings. Let's say you want to donate $15,000 to charity. If you donate $15,000 in the company stock that you originally purchased for $5,000, you avoid up to $23,380 in capital gains and net investment income tax. And you get a $15,000 charitable deduction. That's significantly more tax efficient than donating $15,000 in cash, which only saves you the deduction amount. For 2025, long-term capital gains rates are typically 15% or 20% for most taxpayers based on income level, and high earners may also pay the 3.8% net investment income tax. By donating stock, you avoid these taxes entirely. Now, there are deduction limits to be aware of. For stock donations to public charities, you can deduct up to 30% of your adjusted gross income, compared to 60% for cash donations. But the tax savings from avoiding capital gains often outweighs the lower deduction limit. Here's where the strategy gets even more powerful for executives: donor advised funds, or DAFs. A donor advised fund is an account held at a public charity. You contribute appreciated stock to the donor advised fund, receive an immediate tax deduction for the fair market value of the stock, up to 30% of your AGI, and the DAF sells the stock without triggering capital gains tax. You can then recommend grants to IRS qualified charities over time. For executives, donor advised funds offer several advantages. First, you get the immediate deduction in the year you contribute, which is especially valuable in high income years when you're receiving significant stock compensation. Second, you have the flexibility to distribute the funds to charities over multiple years, allowing you to separate the tax benefit from the actual giving timeline. Third, DAFs provide anonymity, consolidated record keeping, and the potential for invested funds to grow tax-free within the fund. Let me share a common strategy I see successful executives use. They contribute a large block of appreciated companies to a DAF in a year when they have significant RSU vesting or option exercises, capturing a substantial charitable deduction to offset that high income. Then they make annual grants to their favorite charities from the donor advised fund over the following years. This approach helps diversify out of a concentrated company stock position, provides meaningful tax savings, and supports causes you care about, all at the same time. The fifth tax move is building Roth IRA access through backdoor contributions and mega backdoor strategies, even though you're a high earner. For 2025, Roth IRA income limits mean you can't make direct contributions if your modified adjusted gross income exceeds $165,000 as a single filer, or $246,000 if you're married filing jointly. But there's a legal workaround: the backdoor Roth IRA. Here's how it works. You contribute after-tax dollars to a non-deductible traditional IRA, then immediately convert those funds to a Roth IRA. You owe taxes only on any pre-tax dollars and earnings converted, not on the after-tax principal you contributed. The maximum contribution for 2025 is $7,000 or $8,000 if you're age 50 or older. Now, if your company 401k plan allows it, there's an even more powerful strategy: the mega backdoor Roth. This allows you to contribute after-tax funds to your 401k beyond the regular employee deferral limit of $23,500 for 2025. The total 401k contribution limit, including employee contributions, employer matching, and after-tax contributions, is $69,000 for 2025, or $76,500 if you're age 50 or older. You can contribute after-tax dollars up to that total limit, then immediately convert those after-tax contributions to a Roth 401k or roll them into a Roth IRA. This strategy lets you get tens of thousands of dollars into Roth accounts every year, far beyond the standard $7,000 Roth IRA limit. Why does this matter so much for executives with stock compensation? Because most high earners are already heavy in pre-tax retirement accounts, like traditional 401ks and IRAs. Your employer likely matches your 401k contributions. You're maxing out pre-tax deferrals to reduce current taxes, and over the years, these accounts can grow to substantial balances. But here's the problem. Every dollar you withdraw from those pre-tax accounts in retirement is taxed as ordinary income. Plus, once you reach age 73 or 75, depending on your birth year, the IRS forces you to take required minimum distributions, or RMDs, from traditional IRAs and 401ks, whether you need the money or not. Those RMDs are fully taxable and can push you into higher tax brackets, increase Medicare premiums, and create a tax bomb in retirement. This is why building Roth accounts through backdoor and mega backdoor strategies is so valuable. Roth accounts provide tax-free withdrawals in retirement and are not subject to RMDs during your lifetime. This creates crucial tax diversification. Having both pre-tax and Roth funds gives you flexibility to manage your tax brackets in retirement. You can draw from Roth accounts when taxable income from Social Security, pensions, or RMDs might push you into higher brackets. You can also reduce the tax impact on your heirs, since Roth IRAs are inherited income tax free. For executives who are already maximizing pre-tax contributions and receiving stock compensation that adds even more taxable income, building Roth balance is essential for long-term tax efficiency. Now here's where all of this comes together. These 5 tax moves aren't isolated strategies. They work best when integrated as part of a comprehensive executive compensation plan. Let's imagine a hypothetical scenario to see how this works. You're an executive earning $300,000 in salary with $200,000 of RSUs vesting this year. Here's how you might implement all 5 strategies. First, you adjust your W-4 withholding and make quarterly estimated tax payments to cover the full tax liability on your RSUs so you avoid those underpayment penalties. Second, you harvest $40,000 in your losses from your taxable investment portfolio. You use $30,000 of those losses to offset capital gains from diversifying out of some concentrated company stock. And you use $3,000 to offset ordinary income from your RSUs. You carry forward the remaining $7,000 to use next year. Third, you defer $50,000 of your salary into your company's non-qualified plan, reducing your current taxable income from $500,000 to $450,000, deferring that tax liability until retirement when you expect to be in the lower bracket. Fourth, you donate $20,000 of highly appreciated company stock to a donor-advised fund, receiving a $20,000 charitable deduction and avoiding capital gains tax on shares that had only a $5,000 cost basis. Fifth, you make a $7,000 backdoor Roth IRA contribution, and because your 401k plan allows it, you contribute an additional $30,000 in after-tax funds to your 401k and immediately convert it to Roth, building tax-free retirement savings. When you add it all up, these 5 strategies can save you tens of thousands of dollars in taxes in a single year, while positioning you for more tax-efficient retirement. But the key is proactive planning. Don't wait until tax season to think about these strategies. Work with your financial advisor and CPA throughout the year to implement them strategically based on your vesting schedule, income projections, and long-term goals. Stock compensation is an incredible wealth building tool, but only if you manage the tax complexity the right way. These 5 tax moves, strategic RSU withholding, tax loss harvesting, deferred compensation, charitable giving with appreciated stock, and backdoor Roth strategies can help you keep significantly more of your compensation and build wealth faster. If you're an executive or high-earning professional and you want help implementing these strategies as part of a comprehensive retirement plan, I'd encourage you to schedule a call with our team at Trello Wealth. We specialize in helping families and retirees simplify financial complexity with personalized planning and disciplined investment management, so you can move into retirement with clarity, confidence, and peace of mind. You can schedule a call at the link in the description. Let's make sure you're maximizing every dollar of your hard-earned compensation.